Perfect. Well, thank you everyone for your time this morning, and thank you to GP Agency for bringing us on to talk about Thrivent's product. I am really excited about this solution. As Marshall mentioned, I've been doing this for 23 years, and this is like one of the most exciting products I've seen in recent memory. And I'm going to cover quite a bit here in the next 30 minutes or so, so I will make sure that Marshall has any follow-up items, pieces that I might mention or reference during this, but you have a really unique advantage right now in being able to offer Thrivent solution to your clients, as people are really concerned right now about the strength and stability of some of the carriers that are out there, especially some of the stock-owned ones that have been around. And they've also heard about some of the longtime insurers leaving the market in the past year. Mass Mutual left earlier in the year, and Transamerica exited the market in March. So you now will have access to what I believe is one of the most benefit-rich standalone solutions on the market that just happens to be backed by the strength and stability of the country's largest fraternal insurer. So I'll start our conversation today with a little bit of the Thrivent story, talk about our history in long-term care, and then really dive into our key differentiators. So I'm going to probably focus more on where we're different than where we're the same, or some of the basic things that you'll find in most long-term care policies. So first off, who is Thrivent? So we are the world's largest fraternal organization. And if you're not too familiar with fraternals, they are not for-profit organizations where the members all share a common bond. You're probably familiar with some non-insurance fraternals in your neighborhood, your Rotaries, your Lions clubs, all of those kind of groups, your Elks clubs, they're fraternal organizations where everybody has a common bond of some sort. So with Thrivent, we have that in that our common bond is our members are Christian. So some of you that have been around for a while, we used to be known as Thrivent Financial for Lutherans, but we opened up membership to all Christianity in 2014. So a simpler way to talk about Thrivent, without, getting deep into the religion part or faith part, is to talk about Thrivent as being a financial cooperative where all of the members or our policyholders are owners of the company. So we're not a stock company. So it's really important for people to understand that we're not beholden to Wall Street interest every 90 days. So we're more like a mutual company in that regard. But unlike a mutual for that not-for-profit tax-exempt fraternal status that we have, Thrivent is required by law to give back to our community. So as such, you'll see we are the country's largest supporter of Habitat for Humanity. And you've very likely seen people out in your community working on various service projects wearing Thrivent's Live Generously t-shirts. All of those little service projects, community projects, are funded in some way by those Thrivent fraternal dollars that we're putting back into the communities. And so I will share with you how to discuss Thrivent's common bond requirement probably towards the end of this presentation. I'm not going to be dodging it throughout here. It's just I tend to get the Christian question throughout. I save it towards the end because if there's one thing I want you to leave with today, it's a really clear understanding of how to position us, and especially to position Thrivent as an option if you're maybe not sure of somebody's faith. So we've got a real easy way to do that without offending anyone. So a little bit about us. Our ratings are going to be hard to beat. We are A++ rated by AM Best. We have a Comdex of 99. That's about the highest you can get out there. And we are the only one of the top 3 highest rated carriers that is available to independent brokers. New York Life and Northwestern Mutual both have great ratings as well, but as you know, they are captive distribution only. So you might be wondering, is Thrivent new to long-term care? Well, that's kind of a yes and no answer. So Thrivent began as 2 separate fraternal organizations, Aid Association for Lutherans and Lutheran Brotherhood, and both of those companies began selling long-term care back in 1987. The 2 companies both sold their own products until they merged in 2001 to form Thrivent Financial. So at that point, Thrivent was offering other carriers long-term care solutions for a few years because we were busy getting all of our other lines off the ground, our life insurance, our annuity, things like that. But because we so firmly believe in solving the long-term care need for our members, we re-entered the market with our own product in 2012. And we are now on our 2nd generation of product, this one being priced and launched in mid-2016. So it's still a fairly fresh product. But if you think about it, Thrivent has the benefit of over 30 years of experience in long-term care solutions, but maybe without some of the baggage, that negative baggage that comes with the carriers that have been doing this with their own product the entire time, with some of those missteps that they made with things like pricing and underwriting and some of those other assumptions that they made in the late 90s and early 2000s. So AAL was formed in 1902, Lutheran Brotherhood back in 1917. So you're actually working with an insurer whose roots that go back over 100 years. So we're not a new organization, we're just a newly combined organization. And Thrivent has never had, just the cheapest prices out there on the market in general. We've been a fairly conservative company. And so we haven't had any of those huge rate increases that you've seen some of those stock-owned carriers have over the years. I just like to be transparent when I'm talking about us. You'll see here on the screen some of the averages. We had one price increase. It was back in 2004. It was back on the old AAL and Lutheran Brotherhood blocks of business. And it was just the one time, and I think when I averaged these out, it came out to about 22% across all these policies. So very modest compared to some of the high double-digit or even triple-digit increases that you've seen some of those other big carriers have over the years. And then just to be clear, there have been no increases on any of the Thrivent branded products that have been available since we re-entered the market in 2012. And just a little bit about how we work for health pre-screening, underwriting, and claims processing. We went out and teamed with one of the most experienced partners out there, LTC Group. If you do long-term care, you're probably very familiar with them as they support many of the other leading carriers in some way, shape, or form. The great thing for us is we are headquartered in Minneapolis. LTC Group is in one of the Minneapolis suburbs, so we probably have one of the best relationships with them that any carrier is going to have because they are literally right in our backyard. So a little bit where Thrivent fits in the greater scheme of things. I like to show a little context. So 10 years ago, if you looked at who the biggest insurers were, you would see it was companies like Genworth and John Hancock. It was a lot of stock-owned carriers back then. But now jump to 2020, last year's end of year numbers, Thrivent was the 6th largest traditional carrier at the end of last year. If you take a look at this, you'll see that the number 5 carrier, Transamerica, as I mentioned, they exited in March. Mass Mutual, last year's number 7 carrier, also left the market. But the key thing to note here is that many of the top carriers are now mutuals or fraternals. And we believe this is because consumers are looking for products that are backed by the strength and stability that you find in these type of carriers. It's something you're going to see if you even look at linked benefit carriers. Most of them are mutuals these days. So real quick on this screen, I'm going to just share with you some of the key things that we're going to be talking about in depth in a few more slides here, but I just want to give you a quick rundown of some of our key differentiators. So first off, we do issue ages 18 to 79. Other carriers, they might limit this to maybe 40 to 75. We have a 5-year rate guarantee built in. Most other carriers no longer offer rate guarantees. We have a shortcut built in with our elimination period. Instead of actual service days or 1 = 1, we have 1 day of care in a week satisfying that entire week towards the elimination period. We can even make that a shorter shortcut with a rider that we'll discuss here in a bit. But what I really like about Thrivent's plan is you can design some really robust plans for people that really want the best in something. Here we can go all the way up to an 8-year maximum benefit if we want. We can go up to $15,000 a month. We've got some really cool options for inflation. We've got one of the few 10 pays that is available on the standalone side. And then we've got a lot of great riders that you can really use to customize a plan. So just some of the basics. Our policy is built on a reimbursement model. And as you'd expect in any modern traditional long-term care policy, we're going to cover services and care in a variety of settings: home care, residential facility care, adult day care. Our policy is a tax qualified plan. It's been filed for partnership in most states. And the one state we do not have a product in is New York. And we are not looking to have a New York product at any time in the near future. So I'll break the conversation now down into two buckets. We'll talk about some of the built-in benefits, and then we'll talk about some of those riders. So as far as built-in benefits, we have a built-in waiver of premium where we're going to waive that premium once the elimination period is satisfied. But if you buy shared care with us, you're also going to have a double waiver of premium built in, where we're going to waive the premium for both individuals, even if only one of them is actually receiving benefits. I really like our care coordinator services. To me, this is one of the least talked about benefits in any long-term care policy, but I think it's one of the most crucial for families when they are in that crisis mode. They don't know where to turn. They start Googling. If they're old school, they go to the yellow pages, if you can even find those anymore, and they start flipping through it, trying to find who can help them. Care coordinator services do all of that and more. And with Thrivent, you don't need to use our care coordinator services in order to access any of your policy. But if you do, these charges are not going to come out of your benefit pool itself. These are actually covered separately by Thrivent because we so firmly believe in the value that care coordination brings to families when they are in that state of crisis. Just some basic things. We have bed reservation in a facility for up to 60 days per calendar year. To help with things like emerging services and technologies, we have an alternate care provision built into our policy to cover some of those things that might not exist yet. We have a contingent non-forfeiture benefit built into every policy in the event of one of those substantial premium increases I mentioned other carriers have had over the years. But then we get to what we call our ancillary benefits. So these are included in all of our contracts again, and this covers things like respite care, equipment and home modification, caregiver training, and an international care benefit. And each of these is equal to 2 times whatever your maximum monthly benefit is. The reason I call that out in particular is when we get to international care. So when you're talking the equivalent of just 2 months worth of benefit for international care, that's going to be less than what you'll find with many of the other carriers. So if international care is a primary concern for your clients, I'll admit we may not be the best fit. So again, some areas we differentiate: basic building blocks of a policy. So our elimination period, you can do 30, 90, or 180 days. And as I mentioned earlier, instead of actual service days that some of the carriers still offer, with Thrivent, it's built in. Just 1 day of care in a week is going to satisfy that entire week towards your elimination period. Again, really robust benefits. We can do monthly benefits from $1,500 up to $15,000 a month in $100 increments. A lot of other carriers now max out at maybe $9,000 or $10,000 a month, so we can do a lot more here. And then while other carriers might max out at maybe 5 or 6 year benefits, we can do 2, 3, 4, 5, and 8 year benefits. You can also add shared care to our 8-year benefit for a couple. So if they each have 8 years, you now have a 16-year shared pool between couples, which I like to call the next best thing to an unlimited plan these days. We have 2 types of inflation growth available. I'll start with the most popular and familiar to you. It's our annual increase benefit, but these are your traditional compounding inflations. We do 1, 2, 3, and 5% compound. I'll let you know right now, due to another carrier's price refreshes late last year, we are very competitive when you look at 3% compound in particular, so take a look at us there. And then also because we have 1 and 2% compound inflation, you can design some plans. In 20 states, you can design partnership plans with 1 or 2% floors for compound inflation. So you can do some stuff here with us that you can't do with some other carriers that might only have a 3% or 5% compound inflation. Our other option is a little unique. This one is a buy-up option that we call our flexible increase benefit. So here, every year, you will receive an offer to buy up 5% compounded at your attained age with no evidence of insurability. So you're going to be tacking on a little 5% compound benefit to each one of those that you accept. And it's going to happen automatically unless you choose to opt out. So it's not an opt-in where you have to remember to do it. You have to actually opt out that year when you receive that offer at your policy anniversary. So your premiums for each of those little 5% buckets that you're going to buy, each one of those is going to be priced at your age at the time of that increase. So over time, it does end up being a little bit more costly if you buy every single one of the, you buy every one of those. But a lot of people do like this option for the control it gives them over their policy and their growth. And here, if 3 consecutive offers are declined in a row, at that point, no future offers are going to be extended, but the rider stays on your policy, because what happens is when you go on claim, that actually kicks back on and it starts increasing with no cost to you. And I will show you how that works right now. So in this scenario, we have a client named Mary who buys a Thrivent contract at age 50, and she chose the FIB rider because it was going to help her manage her premium increases. She knew she was going to have some cash outlays for things like her kids going to school and, maybe some marriages, weddings, things like that. And so she wanted to be in control of whether, she accepted or declined an offer. And her initial goal when she met with her planner was to accept increases whenever she could until her benefit amount reached at least $15,000 a month. So starting on the left side of the screen, over the next 20 years, Mary accepts 13 annual increase offers. They're in the gold, and she declines 7. They're in the blue. However, she didn't decline the offer in 3 consecutive years, so that meant her flexible increase benefit continued to be offered each year. Jump to the middle of this chart at age 70. At this point, Mary reviewed her benefits, and she sees that she's gotten to about that $15,000 a month benefit that she initially had wanted, and she still thinks that this is going to be able to meet her future needs. So at this point, she declines all future increases. That's why we see the 3 blue bars in a row. At that point, no future offers are going to be extended, so we transition to those gray bars. Now at age 80, Mary's health unfortunately goes downhill. She needs to go on claim. But at this point, the FIB actually kicks back in, and it's going to increase whatever her monthly benefit is and whatever is left in her benefit pool by 5% compounded annually. And it's going to continue to do so each year while she is receiving care. That's why you see it ticking up in gold again there at the end. So the great thing about this for her is she doesn't have to worry about paying premiums on any of those 5% growths at the end, because she has as a standard benefit included with her policy that waiver of premium. And in the illustration software, you can really play around with pricing to show how different scenarios might play out for somebody. The FIB option, this can be partnership qualified dependent on age in 26 states, as long as you meet that state's buy-up requirements. And it does vary from state to state. Some make you do it every single year up through age 75. Some it's 2/3 of all offers. Some it's every third you have to take, something like that. So you do want to be familiar with the rules around any given state. I will make sure that Marshall has our partnership grid to share with you. But one example is I live in Minnesota, and here we require somebody to accept all of these offers up through age 75 to be partnership qualified. So in the example here on the screen, Mary's policy would have actually lost partnership qualification after she declined that first offer at age 57. So I know a lot of you probably won't show this option to people. I do like to explain it, though, because we get a lot of questions on it. It's probably most popular with Thrivent's career network of agents or those who have annual reviews with their clients, because you do want to make sure they understand the need to continue buying up, either to maintain a partnership status or to just keep growing their benefits. But for simplicity, most people are looking to our 1, 2, 3, and 5% compound inflations. So let's discuss some of our other riders that are available. If I mention some percentages here, these are going to be ballparks. They can be impacted by other factors like elimination period, marital status, risk class, things like that. But I like to give you an idea of what things cost. First off, we have an additional cash benefit rider. So I did not say alternate cash benefit like some policies might have, where you can either receive 100% reimbursement that month, or you can receive only 25%, but it's as cash. Here we give you the best of both worlds with this rider. You can receive your 100% reimbursement and then an additional cash benefit on top of that. And that cash benefit is going to be equal to either 15% of your monthly benefit if you are receiving home care, or 10% of your maximum monthly benefit if you are receiving facility care. And this is not going to draw down your benefit pool quicker by using this rider. This is paid out. This is an additional benefit. So this is paid additionally on top of your reimbursement policy. And the cost of adding this rider runs about 16%. Clients don't want to use it or lose it. We do have a non-forfeiture rider where it just needs to be enforced for 3 years before they decide to terminate their coverage. The cost of this one runs about 8%. We have a return of premium upon death rider that's going to return any premiums paid minus claims paid to the insured's estate. Here, what I find interesting is the rider has to be in force for 10 years before death occurs in order for it to be eligible for payment. And because of that stipulation, we found this is one of the more affordable return of premium options that you're going to find on the traditional side. And the cost of the return of premium, this one does vary with issue age, but a couple of examples, it runs about 25% for somebody age 50 to 49% for somebody age 65. We do offer shared care. Here you can link together 2 contracts. So again, it's not a third pool concept like you might find with some carriers, but it's linking together 2 pools. If one spouse uses all of the healthy spouse's benefit, that healthy spouse can go out and they can have an option to buy a 2-year benefit for his or her use only. We can get you details on that. It's priced at their current age. It's available up to age 80, but there's no evidence of insurability. If one of the people dies, the survivor's contract is increased by whatever is left in the deceased person's benefit pool, but the shared care rider cost is going to be dropped from both policies, but the spousal discount remains in place for the survivor. And a couple of examples of what this one runs, it's about 25% to link together 2 3-year plans, to about 16% to link together 2 5-year benefits. We also offer a survivorship rider. It's fairly standard to what you'll find in the industry. It runs about 10% to add that. Again, when we come to elimination period, I said we have a built-in shortcut. We can also make that even shorter with a 0-day for home care with our waiver of elimination period rider here. This one runs about 10% for, this one costs about 7%, which is really affordable in that we've priced out some of the other carriers and they charge as much as 10%. So this is another differentiator. We offer a 10-pay option, one of the few on the traditional side. You pay up your premiums in 10 equal payments. There is going to be, of course, a reduction in commission for you, the agent. But we do have this. It's just not going to be available with a few of our riders. Discounts, it's another spot we differ. We have a 10% preferred health discount. We have a really easy to follow preferred health checklist in our underwriting guide. You can also pre-qualify any health conditions by talking to somebody like Marshall or by calling LTC Group and pre-qualifying that with them. But we also have a really generous couples discount. So again, leading carrier changed their pricing late last year. So we now have one of the more generous couples discounts. We have a 20% couples discount if both are applying and approved for coverage, or if just one person in a couple applies or is just one of them is approved for coverage, they will receive a 5% couples discount. So you might wonder who qualifies for that couples discount. It's going to be any married couples, civil unions, domestic partnerships. I like to be crystal clear. It does include same-sex partners because we get that question quite often. But it's also 2 individuals who are living together for at least 3 years in some type of committed relationship as partners or family members, and are committed to sharing expenses, are not married, and if related, they must belong to the same generation. So brothers, sisters, siblings, cousins, things like that. But not only could you apply for and get the couples discount, but a couple in that regard could also apply for and get shared care with Thrivent. So now I'm going to hit on some sweet spots. Couples pricing due to our competitive couples discount. Again, because they're priced very competitively, our return of premium rider, our home care 0-day elimination period. We also found this concept, our product, is very popular with high net worth clients. And the reason for that is they appreciate the more robust plan design that you can show them here. You know, they're used to looking for the best in something. With Thrivent, you can design what we used to call back in the day Cadillac plans, really fully loaded, really robust policies here. I mean, you can do that 8-year maximum shared care, so 16 years, you can go up to $15,000 a month, additional cash benefit rider, 5% compound inflation. You can do all of that here. So for somebody that really wants the best that they can buy, we can do that. I'm now going to jump off of script, and I unfortunately do not have a slide for this because underwriting niches are tough to get approved by our compliance, but I do want to share some sweet spots for you there. First and foremost, you do not need to have seen a doctor in the past 24 months in order to apply. Other carriers might make you see a doctor in the past year or two to even look at you. Thrivent does not. Now, that being said, if you haven't seen a doctor in the past 2 years, you cannot be considered for that preferred health discount, but you can still apply for standard coverage. That preferred health discount I mentioned, Thrivent issues about 4% more cases at preferred than our leading competitor. We'll look at a variety of cases that, I've seen other carriers decline or rate. We'll look at, a lot of things based on stability and any other effects, but a couple of examples. We'll look at someone recovered and treatment-free for stage 4 Hodgkin's. I know a lot of other carriers won't even look at that. We're pretty good with some things like severe anxiety or depression as long as it's stable. Type 2 diabetes, A1C can be up to 8.5. So with Thrivent, we're looking for stability of meds or insulin, so we don't have a maximum number of units listed if you look in our underwriting guide. So if insulin is being used, you again do want to discuss that with that pre-qualification line. And then Thrivent won't automatically decline somebody just based on another carrier saying no. So that being said, we're not just going to take anybody else's decline. Take whatever information you have on that decline. If you think that person should have been able to get coverage somewhere, bounce it off that pre-qualification line. I have seen people get coverage with Thrivent that they did not get from some of our friendly competitors out there. Some other spots you might want to look at Thrivent. We have nationwide pricing, not state-specific pricing. So we're very competitive in states like Florida or California, where others might have state-specific rates. We offer one of the only partnership policies in the state of Indiana. And then a few other things. If you are selling in Washington right now, as many of you might know, Washington has an act, a trust act, and people have the option to opt out of this mandatory payroll tax if they own long-term care insurance, but they have to buy a policy before November 1st. So with Thrivent, that might be an option for you because we will allow premium with application. It's not a pre-appointment state in Washington for us as it is with another carrier. And you just have to request that the date of the application be the effective date of the policy. So we're a great option there as well. So I know I'm running out of time, so I got to cover 2 things real quick. So I'm just skipping through some of the slides about our illustration system because I want to get to the 2 biggest questions. Second biggest question, how does Thrivent compete on price? So take a look at some of the biggest names in the industry right now. I only ran A+ or higher rated insurers. You can see we've got 2 available through captive distribution here, 2 available to independent producers. Tried to match everything up as apples to apples as I could for this 57-year-old couple, all things being relatively equal. With Thrivent and Mutual of Omaha, I still added in 0 day for home care because it's not available with the other 2. And then shared benefit, just because not all of them offer shared benefits. So when you are comparing against not just the top insurers in this space on ratings, you see that Thrivent also is very competitive. You're getting quite a bit of bang for the buck with us in a lot of scenarios, especially if you're looking at people in their 50s and early 60s. Take a look at us. And this comparison you see here is showing Mutual of Omaha's less expensive option. Their secure solution, their custom solution, more often sold to couples, it's priced even higher. But I just want to give people an idea of where we fit price-wise. Biggest question, though, is the Christian question. How do you talk about it? As I mentioned, we are a fraternal organization whose common bond is that we serve Christian members. So as such, there is one and only one Christian-related question on the application. And it's one of the very first questions you're going to see because we don't want people to get all the way through before knowing whether they qualify or not. And the question is pretty simple itself. It's here on the screen. I am a Christian seeking to live out my faith, or I am the spouse of a Christian who seeks to live out his or her faith. That's it. It's you know, something, it's an honor-based question. They don't investigate this. There's not going to be a private investigator out in front of your house on a Sunday morning checking you out. They don't ask you, you know, how many of the 10 commandments can you name or have you broken, anything like that. What they do is this is an honor-based thing. And because of the way the question is worded, you can actually have people from mixed faith marriages or people without faith get coverage with Thrivent as long as they are married to a person who is Christian living out their faith. And if you don't know what kind of opportunity that means for you, I've looked at several national surveys. They all show that about 70% of the American population self-identifies as Christian. So odds are many of the people you work with or talk to on a daily basis would be eligible to apply for Thrivent coverage. But how do you bring this up as an option with your client, especially if you don't know somebody's faith? Maybe you sell like to internet leads. You've never met this person in real life. You've never had a conversation before today. Well, this approach works really well in teeing up Thrivent by putting your client in charge of whether you can proceed or not. And what you say is something like what's on the screen here, and I'll make sure that Marshall has this to share with you, because we found this is really non-offensive to people. You just say, you know what, I've got a couple of different solutions I'd like to discuss with you about long-term care. One that I think you might find interesting is from a fraternal benefit organization called Thrivent. So they're a top-rated financial services organization. You can't beat any of their ratings. And they are a financial group that was formed to serve Christians. So I don't know if that's an option for you. And you know what, if it's not, that's okay, because I have a couple different options we can discuss then. And at that point, stop talking. They'll let you know whether you can proceed, or they'll say, you know what, that's not for me. What else do you have? And then you just pivot to another solution. So no harm, no foul, and you just move right along. You don't have to get any deeper than that. On a related note, while you do have to be Christian or married to one to buy Thrivent's product, you do not have to be Christian to sell Thrivent's product. So I know I went through quite a bit there, but there really is no better time than right now to be adding Thrivent as an option to get started with anything Thrivent, whether it's getting appointed, getting a quote, getting applications. Contact Marshall at GP Agency. He'll be happy to help you out. For me, it's fun to run into somebody like him because I've been doing this for 23 years. It's rare when I run into like a lot of people that have done this even longer than me. So I know you've got a great resource in him. But I hope I've shared a great story with you today, a benefit-rich solution from a financially strong and stable fraternal insurer, one whose policyholders genuinely feel good about the company that they bought from because they see that company out doing good in their community. So with that, I don't know if you want to throw any questions at me, Marshall, or...
Yeah, let me, I think I'm unmuted. Yeah, thank you, Craig. Yeah, let's open it up. Melinda, if you'll unmute folks.
I am, yes,
See if anyone does have a question. If you have a few minutes to take them, Craig, that'd be great.
Absolutely, absolutely.
This is Mindy. I just have a quick question. Does the applicant need to sign something in an application to verify they are Christian? Is there something they to say they are?
Yeah, there is just that one membership form, and it really does just have that question. I am a Christian seeking to live out my faith, or I'm married to one. It's really that simple. They don't have to, you know, fill out any additional information. There is a question on the form where it says church name, but it is an optional form, and Thrivent just uses it to you know, gather some information about people in general. So it's not to verify that you go to a church or church at all. We have people that haven't been to church in 30 years. They say they are a Christian living out their faith, and you know, it means different things to different people. So yeah, it's a honor-based question, but they do have to, it's the membership form. It's literally though just the one question that they have to answer.
Thank you.
Basically, Craig, they're joining the fraternity. Are there benefits other than the ability to buy long-term care insurance with that fraternity?
Yeah, there are some. The biggest ones are that you are able to have a voice in where Thrivent puts those dollars. So they have a program called Thrivent Choice, where Thrivent, you can help them vote on, because they have little lodges or chapters that you become part of when you become a member. You don't have to attend these at all. But if you do, and you are into that kind of stuff, you can, say if you have a pet cause, you can encourage them to donate towards that cause. You also have what they call Thrivent Action Teams, where each year you are given a $250 gift card to use as starter money to grow into something bigger. So our founder at Newman Long-Term Care, which distributes Thrivent to groups like this, her granddaughter has cystic fibrosis. And so she does all kinds of work to raise money for that group. And so what she does is she gets that $250 gift card each year because she bought a Thrivent policy, and she goes and uses that as starter money to buy some raffle items, to buy tickets, print up tickets, things like that. And she puts on a big event that grows that $250 into several tens of thousands of dollars for that group. So it's to help you grow into something bigger. Everybody who's a Thrivent member can apply for that each year and use it. So it's like little things like that. It's the feel good part. I love being part of a company that does this kind of stuff, and our policyholders do as well.
Cool. Any other questions? One thing that you mentioned that I'll just emphasize with the inflation that can go down to 1%. A lot of times partnership is in play. People want partnership, maybe of, not wealthy people, but it can make a difference. And in North Carolina, for example, you can go down to 1% if they're in the 61 to 75 bracket. That 1% inflation qualifies for partnership. Now under 60 and under, it has to be 3% compound, but that's here in North Carolina, and it varies by state. And I know not all of you on this are North Carolinians, but that's kind of a neat thing to keep in mind, that they have that capacity to do that.
Yep, your policy just doesn't grow as quick, but if the difference is they either can have a policy that's partnership qualified at 1%, or they like that partnership, but they can't afford it at the 3% compound inflation somebody else might show them. It's a no-brainer. Bring it down to 1 or 2%. We've sold so much more of that since Minnesota implemented the 1% rule here. We've seen a lot of people. I would say the bulk of our policies are probably with the 3% yet, but we do see a lot of 1 and 2% across the country now.
Very good.